First of all, is about inheritance tax, the threat of inheritance tax. Actually, it's nothing new. The inheritance tax affects every family in Britain, or every person that owns fixed assets in the UK at their date of death. And there's a personal allowance of £325,000 that can be handed over on death. The issue that has been raised in the press is the fact that that is been fixed, and it's not going to change anywhere between 2020 to 2028. So the nil rate band of 325,000 has been limited, so that with the price of property and shares going up year by year, more and more families are being caught up in the internet inheritance tax bubble as it goes along. They're projected to have a 63% increase in the inheritance tax take before 2028. And this is a tax that's charged on an estate. So if somebody dies and there's an inheritance tax liability, that inheritance tax is payable within 6 months of death. Now, on first death between a married couple, there are exemptions. So the £325,000 allowances between parties that could be passed to the next person. There's also an additional property allowance. So a family could pass up to £1 million on first death of a married couple to pass over on second death. But beyond that, then inheritance tax will start applying. But when a terraced house in London can cost £1 million, it quickly starts to add up. And if you've got £1 million that is liable for inheritance tax, that's £400,000 that needs to be paid before probate is granted and within 6 months of the date of death. So it's a big issue if you've got that liability, and if you haven't got the resources in the estate to be able to meet that tax bill without penalties and liabilities. And this is where Proactive Family Office can come in, because gifts can be made during a lifetime to reduce the amount of tax that's charged to inheritance tax, to reduce the amount of the estate. So families can gift to each other, and potentially that gift can be exempt after 7 years and free of inheritance tax. It's a progressive thing. So with a long-term plan, you can create a family trust to hold assets to pass to your next of kin. Once in a family trust, there is no inheritance tax that's be chargeable on that asset when that passes. Now, there's restrictions on and taxes that are applicable to trusts in the UK. However, Cyprus International Trust doesn't have any taxes for expats on worldwide assets. So there's a potential to transfer business, investment, and property assets into a Cyprus International Trust and avoid inheritance tax in the long term. What you can't do is avoid the liability on your deathbed. So if you've not made any planning and you're about to die, then the inheritance tax liability is going to come knocking on the door. If you plan ahead and make those gifts, you can retain control and give to the family, and the family can enjoy it down the generations. So for more information and guidance on how to protect your family's wealth, wherever those properties and investment assets are around the world, contact us at proactpartnership.com.